Hello, everyone. Welcome back to Airlines Quest. Today, we're going to dive into the aviation industry, which has been facing some turbulent times recently. From Boeing's manufacturing woes to the impact on airlines, the ripple effects have been felt throughout the sector. In recent months, Boeing's share price has plummeted, mirroring the literal fall of some of its aircraft parts from the sky. A series of harrowing incidents involving defects on Boeing planes has shaken the industry, with some cases being routine hiccups, while others involved alarming oversights. The most infamous incident was the loose bolts that led to a door plug panel from an Alaska Airlines 737-9 MAX landing in the yard of an Oregon schoolteacher on January 5th. This latest round of manufacturing debacles and quality control problems led to the resignation of Boeing's CEO, David Calhoun, and prompted the Federal Aviation Administration, FAA, to crack down on the manufacturer, limiting its ability to deliver new aircraft. These events have caused headaches for investors, with Boeing's shares down more than 30% year-to-date in mid-May, and other aviation and airline stocks also tumbling. However, in an industry as essential to the economy as aerospace, any bad patch can turn into an opportunity. So let's explore whether Boeing or the airlines that fly its planes might now be bargains. Despite the cascade of disasters and the deep-rooted cultural problems underlying them, there's a case to be made for Boeing as a long-term play, because the company enjoys the benefits of a duopoly. According to Fortune, Boeing produced around 40% of the 29,000 commercial aircraft flying today, and along with Europe's Airbus, it has a lock on that market for the foreseeable future. Nicholas Owens, an industrials equities analyst at Morningstar, notes that the spectacular nature of aviation mishaps can produce overreaction on the part of investors. The reality, he says, is that Boeing's order book is crammed. The company's report for December revealed net orders of 369, a monthly record, and each order represents hundreds of millions of dollars in sales. If and when the company overcomes its quality problems, that revenue stream could flow freely again. It's worth noting that Boeing brought in $78 billion in revenue in 2023. Owens adds that broader travel trends also bode in favor of the aircraft manufacturer. The commercial aerospace sector has a very long runway of strong demand, he says. Middle-class people all over the world want to fly, especially in places like India and Asia. So, while the recent incidents have been concerning, Boeing's position in the duopoly market and the growing demand for air travel globally could make it an attractive long-term investment for those willing to weather the current storm. Boeing's door plug disaster in January also triggered a drop in airline stocks across the board. However, since then, different carriers' shares have followed different flight paths, showing how much they vary in their reliance on the manufacturer. Delta Airlines, whose fleet comes mostly from Airbus, quickly bounced back. United Airlines shares initially took a hit when the carrier had to ground dozens of 737-9 MAX jets, but they rallied after Boeing agreed to compensate United for lost revenue. Southwest Airlines, on the other hand, took a more sustained hit, cutting routes and trimming hiring as its plans to add dozens of Boeing planes were delayed. Southwest's shares were down 3% year-to-date through mid-May. While Boeing's troubles are likely just a temporary setback for airlines, they're one more risk factor in an industry that offers investors many reasons to be wary. Airlines are highly cyclical. Air travel rises and falls with the macroeconomy. The industry is also both highly regulated and brutally competitive. Because airlines need so much cash to operate, most offer modest dividends or none at all, and bankruptcies are a perennial risk. The biggest challenge for the sector may be that its core product, seats on planes, has historically been viewed as a commodity, forcing airlines to compete on price alone. However, new trends may be addressing that drawback, at least for the Big Four: Delta, United, Southwest, and American Airlines. Bernstein analyst David Vernon says that moves by the major airlines to create more sections within cabins, beyond coach and first class, and to sell more services a la carte have reduced the commodity effect. They're plowing money into their networks, differentiating cabins, and extracting more money from customers, he notes. Ironically, airlines may also get a boost from Boeing's woes. Vernon points out that increased FAA oversight will limit Boeing's output of new aircraft, so the supply of seats will stay tight, protecting carriers' profit margins from overcapacity. Meanwhile, players like Delta and United have significantly increased their revenue from credit card operations, diversifying their businesses and making them less dependent on cyclical travel. While the airlines face their own set of challenges, Their resilience and ability to adapt to changing market conditions suggests that they may also represent potential bargains for investors with a high tolerance for risk. For those looking to invest in the aviation sector but seeking a different trajectory, there's a third option that's, well, flying high: military aircraft. While Boeing and Airbus have footprints in the military aircraft sector, firms like RTX and Lockheed Martin are not closely tied to the passenger jet industry. Geopolitical conflicts around the globe have boosted sales of craft like fighter jets, and contractor order books are likely to grow as Western countries rearm. Stephen Scott, a retired law professor and veteran investor, says he has always stayed away from shares of airlines and commercial manufacturers, but is comfortable buying those that make military aircraft, like General Dynamics. The military aircraft sector may offer a more stable investment opportunity, driven by government contracts and defense spending rather than the cyclical nature of commercial air travel. However, it's important to note that this sector is not immune to political and geopolitical factors that can influence defense budgets and priorities. In conclusion, the aviation industry has been through a turbulent period, with Boeing's manufacturing woes and quality control issues causing ripple effects across the sector. However, within this chaos lie potential opportunities for savvy investors willing to take on risk. Boeing, despite its challenges, could be a long-term play due to its duopoly position and the growing global demand for air travel. Airlines, while facing their own set of risks, have shown resilience and adaptability, with some carriers diversifying their revenue streams and finding ways to differentiate their offerings. For those seeking a different trajectory, the military aircraft sector presents an option that's currently flying high, driven by geopolitical tensions and defense spending. Ultimately, investors must carefully evaluate their risk tolerance and perform thorough due diligence before making any investment decisions in the aviation industry. But for those willing to weather the turbulence, there may be potential bargains to be found among the clouds.